All right, welcome. Today we're diving into one of the most truly mind-bending concepts in all of finance, short selling. It's a strategy that it seems to defy all logic. How can you possibly make money by selling something that you don't even own? Well, let's find out. I mean, it sounds totally impossible, right? It's kind of like selling your neighbor's car and then just hoping its value completely tanks before you have to go out and buy it back for them. So how in the world is this not only legal, but actually pretty common in the stock market? Let's break down exactly how it works. Okay, so to really get our heads around this, we have to start with the core concept. Let's just break down what a short sale actually is. So at its very core, short selling is really just a bet. It's a bet that a company's stock is going to go down. Most investors, they buy a stock hoping it'll go up, right? That's what we call a long position. A short seller is doing the complete opposite. They're actively betting against a stock's success. So here's how it all plays out, step by step. First off, you find a stock you think is way overvalued, and you borrow shares of it. Then, step 2, you immediately sell those shares you just borrowed at their current high market price. Step 3, you wait. You hope your prediction was right and the stock price falls. And finally, here's the magic part. You buy the exact same number of shares back, but now at that new, lower price, and you return them to whoever you borrowed them from. And that gap, that difference between what you sold them for and what you bought them back for, bam, that's your profit. Okay, but that very first step, borrowing shares, that brings up a pretty big question, doesn't it? If you have to borrow shares to sell them, who exactly is lending them to you? And this, right here, is a super important piece of the puzzle. I mean, these shares don't just materialize out of thin air. They have to come from a real owner somewhere. The answer, as it so often does in finance, really boils down to your broker. So the shares you're borrowing, they generally come from one of two places. Sometimes the brokerage firm itself owns the shares, and they lend them to you from their own inventory. But way more often, they're actually borrowed from the margin accounts of other clients. These are just regular investors who have basically given their broker permission to lend out their shares to people like you, usually in exchange for a little interest. So far, this might sound like a pretty slick strategy, right? But, and this is a huge but, this is where we have to talk about the massive risk. This is not a game for the faint of heart. This is the part where short selling gets genuinely terrifying. You see, when you buy a stock the normal way, the most you can possibly lose is whatever you paid for it. The stock can only go to zero. But with a short sale, oh boy, your potential loss is, theoretically, unlimited. And to get why, we need to look at just how lopsided this risk really is. Let me put it this way. Let's say you short a stock at $20. Best case scenario, the company goes belly up, the stock goes to zero. You make $20 a share, a 100% return. Great. But what if you're dead wrong? What if that stock doesn't go down? What if it goes up to $50, $100, $500? Because there's no limit to how high a stock can go, there is literally no limit to how much money you could lose trying to buy it back. Your loss is unlimited. All right, so we've spent all this time talking about the short seller's side of things. But what about the other person in this whole deal? The person who actually owned the shares to begin with? What does this all look like from their perspective? And that leads to a really important question. If your broker has loaned out your shares to some short seller, what happens if you decide you want to sell them? Are your shares now held hostage in someone else's high-stakes bet? And the answer is surprisingly simple. For you, the owner, nothing changes at all. You can sell your shares anytime you want, no problem, no delay. In fact, and this is kind of wild because it's all handled electronically, most of the time the owner has no clue their shares are even being lent out. See, the broker just owes them the shares. So if the original owner hits sell, the broker just juggles things around in the background, finds replacement shares from somewhere else, and the transaction goes through perfectly. But, and here comes another huge risk for the short seller, there's a twist. The brokerage can demand those shares back at any time. They can call them back. If they decide they don't want to lend them anymore, they can force the short seller to close their position right then and there. And that means you have to go buy the shares on the market and return them. And it doesn't matter if you're making a profit or, much more painfully, taking an absolutely massive loss. Whew, okay. I know that was a lot to digest. So let's boil all of that down to the absolute key takeaways you need to remember about this whole thing. Number 1, shorting is a bet that a stock's price is going down. Number 2, The whole strategy depends on borrowing shares. Number 3, and if you take away only one thing from this, let it be this: your profit has a ceiling, but your potential loss is unlimited. Number 4, your broker can force you to buy back the shares at any moment. And finally, number 5, for the person who originally owned the shares, the whole thing is basically invisible and doesn't stop them from selling whenever they want. And all of this really leaves us with one big final question. On one hand, you have people who say short sellers are essential. They're like the market's detectives, exposing fraud and popping overinflated bubbles. But on the other hand, critics say they're just destructive gamblers who can crash a company's stock for their own profit. So which is it? A necessary check on the market or a dangerous gamble with serious consequences? It's a huge debate, and the answer really gets to the very heart of what our markets are all about.